Mentioned the Dow was down more than 600 at the lows after JP Morgan and Morgan Stanley missed Wall Street estimates, raising fears about the rest of earnings season. Joining us now, Richard Bernstein, CEO of Richard Bernstein Advisors, and David Ellison, portfolio manager at Hennessy Funds. Good to have both of you gentlemen here. Dave, I'll start with you as the bank portfolio manager. I know you have both Morgan and JP Morgan in your funds, correct? Were there any big surprises here? Weren't we gearing up for sort of a negative report?
Well, I don't think the reports were negative. Conditions are actually pretty good. I think that's not that. I think the issue is that things are good.
I guess I mean the setup was kind of negative going in.
Yeah, the setup. Well, I think people are worried about credit. They're worried about rates going up. The actual numbers were fine. Credit's fine. I mean, the margins were up a little bit, but the problem is that things are too good, and the bank industry, like some other industries, need a cycle to make money. And we haven't had a cycle in a long time because the Fed's held it up. And so my hope here is that we have a credit cycle, we have a rate cycle, we have a real rate inversion cycle, we have a liquidity cycle, and that allows people like me to actually buy stocks that will go up after that's over, as opposed to sitting here with, everything's good, but the stocks really don't go up when things are really good in this industry.
So to be clear, you're buying now on hopes that the cycle turns again?
Well, the truth is I hope things get worse, because then the stocks will go down and I'll be able to buy them when everybody's afraid, just like in the pandemic, just like in 87, 92, just like after the financial crisis of 2008. That's the time to buy financials, when everything is in trouble, and you buy the best managements. Obviously, Morgan Stanley, JP Morgan are the top of that list. You buy them, you hold on to them, and you make money as they recover. The problem is that everybody's doing well. Everybody has no non-performers. Everybody has decent loan growth. And the non-performers are key. If non-performers don't go up, the stocks won't go down to a point where actually we can build wealth owning them at the bottom. So, again, the money's made when there's blood in the water, and I'm hoping that we have blood in the water. I know that's not what you want to hear or what the market wants to hear, but that's what we need to get to make these stocks attractive.
Rich, what was your takeaway from some of the bank earnings this morning as it relates to their performance, which is weaker again, and we do have that inverted yield curve, and the broader market?
So, Sarah, I think part of it is exactly what you just said. That number one, we have an inverted yield curve, right? I mean, it's a simple model of financial profitability, but it does seem to work, and that is the slope of the yield curve. The steeper the yield curve, the better the margins on lending, the better the margins on activity. And as you just pointed out, we have an inverted yield curve. So that's not real good for the future of banking. Number two, I would point out that if you're a devout monetarist, you're going to say credit is the lifeblood of inflation. And so if you believe that the Fed is going to fight inflation, you should believe that credit is going to slow and credit will get riskier as a result. So on top of that, we have valuations that are down. So in the financial sector, you've got narrow inverted yield curve for all practical purposes. You've got valuations that are down and credit that's under pressure, and that hurts the investment banking side of the equation as well. So this is just not the time to expect banks to be shining stars. It's just the wrong part of the cycle, which I think is what David was alluding to before.
Agree, although I just want to bring up First Republic Bank. It probably has not gotten a lot of airtime today, but that is one of the bank stocks that's higher today, one of the few. It's up 2%. Reporting earnings, really strong loan growth. Dave, strong on a number of metrics. Credit quality remains excellent, according to the CEO, Mike Roffler. How do you explain that, given what we've seen from some of the big banks?
Well, it's a niche bank, does a good job of serving their basically middle to high end customers, and there isn't a lot of credit. The mortgages or the debt, you're buying a $2 million house and you got a big mortgage, and so they do a good job of doing that. They've been doing that for a long time, and they haven't, so it's a growth story, and that's okay. I've owned it on and off over the years. I don't own it now because I think the valuation's too high, and the forward-looking sort of opportunities aren't as good as they were, given the rates are up and housing is cooled. So we'll see what happens. But there's a lot of those in this market. I think the opportunity, and again, that stock is down too, pretty hard from its high. So it's not like it hasn't gone down with the group or with the market. But again, it's a well-run bank. It's a niche. It's done a great job over the years. It has a premium valuation that it deserves. but it doesn't mean it won't get caught up in the maelstrom that seems to be developing here in the market with rates and credit and liquidity problems.